Hi, I'm Mike Ruger. I'm the managing partner at Greenbush Financial Group. Today we're going to be going over what happens tax-wise when you sell your primary residence. So if you bought your house a while ago and it's appreciated in value, the question becomes, when I sell it, do I have a tax liability that's waiting for me? And the IRS has specific rules to this that say if you meet certain requirements, you may not have to pay tax on the gains. So we're going to go through those rules, those dollar thresholds for the gains exclusions, but also we're going to look at some special situations too the client finds themselves in, like such as if a client owns a duplex where they live in one side and it's their primary residence, but the other side is rented out to a tenant. A lot of people don't understand how that gains exclusion rule works or the limitations, because actually one side of the property is actually an investment property in the eyes of the IRS. So we'll go over that. We also have some clients that take a home office deduction. So they have a home office in their house and they take deductions of depreciation against that. They don't know that there are certain tax ramifications when you sell your house that might not be excluded from the gains tax. And the third one we're going to talk about is oftentimes we'll have clients that have vacation houses. They've been renting out that vacation house as an investment property for a number of years, but now they want to move into it. Essentially what happens, like you've had it for an investment property, now it's your primary. When I go to sell it, do I get the full gains exclusion? So we'll go over all those scenarios today. We'll start off by talking about the basic $250,000, $500,000 gain exclusion for your primary residence. So typically, when you own a piece of real estate or any type of investment, when it appreciates in value, you normally have to pay some sort of tax on the gain when eventually you sell it. But the IRS has some really generous gains exclusions for people when they sell their primary residence. So the gain exclusions amounts are, if you're a single tax filer and you sell your primary, as long as the gain is less than $250,000, you don't pay any tax when you sell your house. For married couples that file a joint tax return, the gains exclusion is $500,000. So it's a big amount before you end up paying any type of gain when you sell your house. Now, there are two requirements that the IRS sets forth to make you eligible for that gain exclusion, which is one, the house has to be your primary residence, and two, you have to have occupied that residence for at least 2 of the last 5 years. Let's look at a quick example to kind of illustrate this gain exclusion. So let's say you're married and you file a joint tax return, which means you have a $500,000 gain exclusion. You purchased your house 10 years ago for $200,000, and now you plan to sell it for $500,000. So that means it's appreciated $300,000 in value. Well, you have a $500,000 gain exclusion. So when you sell your house for $500,000, you actually owe no tax. And sometimes people get confused. They'll say, oh, well, I'm selling my house for $600,000, then I'm going to have to owe some tax. It's not the sales price. It's how much the gain was in the property when you sold it that applies to that capital gain exclusion amount. So it's important to know how to calculate your cost basis in the property, because it's really the sales price of your house minus the cost basis, and it's not just what you paid for the property. It's what you paid for the property, your purchase price. You get to add in any capital improvements, which will reduce the gain, and you can also take off the amount that you pay a realtor, their sales commission, off the gain amount. So let's look at an example. Let's say you sell your house for $500,000. And then you purchase the house for $200,000, you made $50,000 in capital improvements, and then you also paid a realtor a 5% commission, so that would leave a capital gain of $250,000. So if you were a single tax filer and this was your situation, you would have to pay no tax when you sell the property based on that gain amount. A special note about capital improvements, you have to be able to be prepared to show proof of those capital improvements. So receipts, if you did an addition, you should have some record showing, yeah, this was a $50,000 capital improvement. If you're really adjusting your basis and saying you have less gain in the case of an IRS audit, they're going to need that document to prove how you calculated the gain when you sold your principal residence. The other nice thing about this gain exclusion, it can be used more than once throughout your lifetime. Technically, it can be used every 2 years as long as you satisfy those principal residence and use requirements set forth in the tax code. So I could buy my first house, live in it for 10 years, sell it and have a $200,000 gain and exclude all of it for taxes. Then I roll that into my new house. I live in that house for 10 years and I sell it again and make another $200,000 on it. I get to exclude that once again, so you can use it multiple times. Now let's look at our first special situation where the owner buys a duplex. So the owner buys a duplex, they decide they're going to live on one side of the duplex and they're going to actually rent out the other side to a tenant. And a lot of people will mistakenly think, well, that because I own the house and it's my primary residence, that if I sell the house down the road for, let's say, a $200,000 gain, I get to exclude all of it, regardless of the fact that it was a duplex or not. That's actually not correct. In the IRS's eyes, in these duplex situations, the IRS views it as two separate properties. Like the side that you live on is your primary residence is eligible for the gain exclusion. The side that you're renting out to a tenant is technically considered an investment property that's not eligible for that primary residence exclusion. Let me show you how this works in an example. So let's say I buy a duplex for $200,000. So I buy a duplex, I live on one side, it's my primary residence. I rent out the other side to a tenant, and now 10 years later, I decide to sell it and I'm gonna get $400,000. So what they do is they split the sales price between my unit as my primary and 200,000 and the rental unit side, and then they also take my purchase price and split it between the two units. So I would have a gain of $100,000 on my unit and on the rental unit separately. Now let's say I'm a single tax filer, I can exclude up to $250,000 worth of gain on my primary, so I can cover the $100,000 on my side. But that gains exclusion is not available for the rental unit, and I will have to most likely pay some type of capital gains tax on that $100,000 when I sell it. Typically, if you own a piece of real estate for more than 12 months, that gain will be taxed at what's called long-term capital gains rate. So it's not taxed normally as ordinary income, but it's taxed at preferential tax rates at the federal level, saying it might be a flat 15% for most taxpayers, maybe a little higher for people on the highest tax brackets, and you may pay a little state income tax. So it's definitely not taxed at the high wage rates, but you will have to. So if I'm kind of a normal taxpayer and I have a $100,000 gain in the property, depending on my state taxes, I might pay 20 grand or so on that $100,000 gain on the rental unit when I go to sell it. So you have to know to set that money aside come tax time. The other item that's really important that comes into play with these kind of rental property situations is the handling of depreciation. So it's not uncommon that when people have rental units, their accountant is taking depreciation on the property, which depreciation, you're allowed to take expenses against the value of that rental unit that offset some of the taxable income you're receiving from the rent, so it lowers your overall tax liability. But the problem is when you go to sell that rental unit, you then have to recapture a lot of that depreciation you've been using over the years to lower your overall tax bill. Let's go back to that example we were just talking about, but now we're going to assume that in addition to what I'm selling it for and what I bought it for, my accountant has also advised me to take $30,000 worth of depreciation over the year. So look at this table. So everything else is the same. The sales price is the same. Purchase price was the same. But now I actually have to add back in that $30,000 worth of depreciation that I've taken. So my gain on the rental unit is now not $100,000, but $130,000 going forward. Another quick note about depreciation, because it's really tricky. When you recapture depreciation, it's taxed at a different gains rate than long-term capital gains. So in that example where I had $130,000 worth of gain, but $30,000 of it was the recapture of depreciation, that $30,000 is taxed at a 25% federal rate, not at the more favorable long-term cap gains rates like the other 100,000 of the property. So you just have to be careful and really work with your tax advisors when you're selling these investment properties in those years. Now, the reason why this depreciation recapture is taxed at a different rate is the IRS recognizes that by taking this depreciation, you've been able to not pay some of this rental income that would have been taxed at ordinary income tax rates, which is much higher. So they say, we're not just going to give you the low long-term cap gains rates, you got to pay a little more because you were using that to offset income over the years. The next unique situation we're going to talk about is converting an investment property into your primary residence, because there's special rules for that. So the most common situation is someone buys a vacation house down south, they create it and they built it as an investment property and they rent it out pretty much year round for 8 years, and then they decide, okay, I'm going to retire, I'm going to move down there, make that my primary residence, I'll live in it for 3 or 4 years, and then when I sell it, I get to take advantage of the full capital gains exclusion associated with my primary residence. Well, the IRS kind of made some new rules back in 2009, which puts a lot of restrictions in place as to how much of that gains exclusion you can use. All right, one of the reasons for the costume change here is I want to go into some detail about how this IRS qualified usage test works, because it's really important. Because when you own a property and for part of the time it's an investment property and part of the time it's your primary residence, you might not have that full primary residence capital gains exclusion available. So the way the test works is the IRS looks at qualified usage and non-qualified usage. So non-qualified usage is technically when it was investment property. Qualified usage, which is when you were using it as a primary residence. So in an example, so if I bought a house and I've owned it for 13 years, but the first 10 years I used it as an investment property, and the last 3 years I moved into it and made my primary residence, when I go to sell it, if I have a $400,000 capital gain built up in that property, they're going to take the 3 years it was my primary, divide it by the 13 years that I owned it, so 3/13, and they're going to multiply that against the $400,000 capital gain I had, and that's the amount that is eligible towards the capital gains exclusion, which works out to about $92,000. So I don't have the full, if I'm married, full $500,000 capital gains exclusion. Because of this usage test, I can actually only exclude about $92,000 from those long-term capital gains. The last scenario we're going to touch on is individuals that have a home office. So you can have a home office and take deductions and expense as the business, but the issue is when you go to sell your primary residence, if you have taken depreciation against that home office, even though you have this gains exclusion protecting the gain of the primary residence, you may have some depreciation recapture from that home office that you may have to pay tax on when you go to sell your house. So just be careful. Thank you, everyone. I hope this was helpful. Just a quick disclosure, we are financial planners. We are not accountants or tax advisors. If you have any tax questions, please consult your tax professional. Thank you.